Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The momentum in Canadian ETFs continues into the 11th month of the year. Despite Canada not being the most popular destination for global investors, the TSX has delivered standout performance driven by sector-heavy markets filled with materials, of course, precious metals leading this charge. And beyond Canada, an interesting trend is emerging in the US. The rise of the so-called anti-factor theme, where companies that traditionally shouldn't really be outperforming are, in fact, and leading the way. So what does this mean for investors? How long could these trends last? And where does this leave those seeking diversification? Joining us here today to unpack it all in this month's edition of the ETF Roundup is Fidelity Director of ETFs and Alternative Strategy, Etienne Joncas Bouchard. And you're right here from Montreal. Thank you for joining us.
Yeah, we're in person. We made it through the blizzard that was yesterday going on in Montreal, and we're very happy to be here.
Did you pull on the old boots? Like it was actually a proper...
We did, yeah, no, we did. It was 2-hour delays at the airport. We got out,
but no.
We had about 1.5 feet of snow, so I was happy to see that you guys, it all melted here.
Yeah, we're just in time for you to land. Well, we're delighted that you're here. Thank you so much. I wonder, so really the news of the roundup of this month is that there's no fear.
Yeah, it seems like investors continue to have a strong risk appetite, and just generally speaking, obviously, from a flows perspective, I mean, the story that we've mentioned a few times, I think, throughout this year is really equities leading the way relative to fixed income. Diversification happening though, like there was a lot of demand for international equities over this year so far. Actually, we can pull up slide 1 and show our audience some of the key themes that we're mentioning here. Obviously, the number one headline is just overall the Canadian ETF industry is in by far its best year ever.
The headline is that bottom line.
Yeah, 95. Let's call it $95 billion in net new assets. With the first week and a half of November, we're actually above $100 billion.
Oh, can you tell us that? November numbers?
It's not a top secret. It's out there.
Okay, good.
Yeah, no, it's been truly incredible. Fidelity, I mean, and thank you to everybody on the line who supported our lineup. Obviously, it's been our record year for us. We're capturing about 10% of the total flows of the industry right now.
Congrats, that's huge.
Yeah, thank you. And really the main part where we've shined, if you will, is in the multi-asset category with our all-in-one ETFs, which I'm sure we'll have a chance to talk about a little bit later today. But to your point with regards to risk taking, we're seeing it kind of in every different category. On the alt side, for example, or inverse levered, or even any alternative theme stuff, we're seeing more and more demand for levered products instead of just long short, market neutral, which was kind of more the traditional side. Fixed income, you're seeing outflows from cash and short-term bonds into corporates, into longer duration products.
More risk.
More risk on both those. On the multi-asset side, there's more and more demand for growth and equity mandates instead of just balance, like a 60-40. On the equity side, you're seeing a lot of demand for either pure beta, or you're seeing demand for things that are more growth tilted. You're seeing a lot of demand come back for US equities in Canada, even over the last couple of months, albeit international's really led the way over the past year to date.
So we are seeing that just slow down a bit, because that's been a huge trend for 2025, but up until maybe October-ish?
Yeah, so actually, so pretty much at the end of Q3, so let's, since the beginning of the fall, we've started to see a bit more demand on US. I mean, there was demand for US equity ETFs. It was just, about every dollar that would go in, there was 2 going to international mandates. It's pretty much back to 1-to-1, and we actually saw it for October. Even Canada also seeing a lot more demand, which is kind of, I guess, it's interesting in the fact that like the Canadian index has worked all year. It took a long time for flows to come back, and I think that was a little bit of the like kind of the fear of missing out, if you will, on the U.S. rally that we've seen since April, but as well as just the diversification demand for outside North America, which was happening, and now.
So we caught some of that. Canada caught some
of that. Yeah, absolutely, and. From a performance perspective, I mean, for international markets, if I use the MSCI IFI index, it's the best performance year to date that we've seen so far since 2013, so more than 10 years. On the Canadian side, it's one of the good years we've had, and on the US side, it's a pretty solid year as well. So like all around, it's been a really strong market. Not what we expected back in March.
No.
And now you've seen, obviously, you've had like as soon as the 90-day tariff pause happened, that was paired with central banks starting to talk about easing, especially in the US and Canada. International, we were already there. So yeah, like risk appetites People are still hungry for risk.
It's still here. It's interesting because you hear a lot of sort of discussion and talk about fear, but in fact, those numbers show that there's actually FOMO, in fact.
Absolutely. But I think inherently, like a lot of advisors and investors that we've had the chance to talk to this year are all kind of, it's just like, not pinching themselves in the sense like, this is great, but we weren't expecting it to be this good. And we're kind of worried that it could flip, right? Or starting to think about defense, but not really pulling the trigger yet on going defensive. But there is some worry, I think, in there, whether that's concentration risk in the U.S., whether that's geopolitical risks ongoing in the Eurozone. In Canada, it's 30 or so % of our return came from the rally in gold. Is that sustainable? All these things, I think, are investors and advisors are aware of them. We just haven't really seen the reaction yet.
So it's really interesting when we're talking about just the interest rate story, which is something actually we don't talk about that anymore. That's not even the story out there. But if you were to look at the interest rate differentials, and you mentioned Canada, Europe, they've been cutting for a while. It was the Fed, obviously, that was catching up. Because of that, are there cycles linked to that? I mean, usually there are. It's been kind of a strange market that way. Are we earlier cycle, for instance, because we got going faster on that?
I think the anticipation, anyways, from our perspective is that, and I think this is fairly much a shared opinion from our asset allocation team or our team of macro experts, is Canada and Europe are likely to be first to go into an early cycle type of recovery. And the anticipation of that means that, obviously markets forward-looking mechanism, what has performed well has been a bit more on the cyclical value side, which is generally more kind of the early cycle type stuff, whereas in the US, it's really the late cycle stuff that's working. So I think the stimulus that's being done by the central banks, as well as, the fiscal spending that's expected from both of those regions, the promises that have been made, would support this kind of overall fiscal and monetary stimulus to eventually have an impact on the economy and then to drive economic growth going forward. That anticipation needs to be delivered, obviously, but right now I think the market's basically telling us we should be experiencing some type of an early cycle / mid-cycle recovery coming soon in those regions. And
even if we haven't hit the recession yet, or if we don't at all.
And I guess best policy is to avoid a recession, right? Like if you can either kind of take a step back from a late cycle to a mid-cycle environment or even kind of skip the recession part. I think certain areas have definitely faced kind of more recessionary pressures.
Absolutely.
And now we're talking about outside of US, but like in the US, there has been a manufacturing recession for the better part of 2.5, 3 years. It's been the longest period where you've seen the manufacturing PMI below 50, which is not indicative of a market that's up more than 15, 20% on an annualized basis in a couple of years in a row.
It has not dragged down the overall story.
No, because it's been offset by a mega trend, right? And so that shift in market, or I guess that different stages of the market cycle will impact factor performance, which obviously is crucial to what we look at, given the way that our all-in-one ETF portfolios are structured. And just basically most of the research that we do is kind of which factors should work when, et cetera. So that's really important for us,
You make sure that the all-in-ones have exposure to all of the factors. So they go through value, momentum, quality, value? What am I saying?
Momentum, low vol, quality, value.
That was it. Because you have exposure to all of them in a way within the all-in-ones, and we'll talk sort of more broadly about them, but you make sure that you catch whichever one is working, essentially.
Yeah, absolutely. Actually, if we can put up slide 2, maybe this I should have probably pulled that up before we went on that little discussion on which factors and where we are, because we've clearly there very simply identified.
Well, now you've outlined it, and here's the picture.
Yeah, there we go. So our objective, our job is, yes, we want to try and figure out where we are so that we can then provide insights into, this is what should be working. But that requires that the management of the portfolio from the advisor side be very tactical in nature, right? So if we say, for example, we like momentum right now, and that's actually kind of true for every region because it does work in the mid-cycle and late cycle, well, that can change very quickly. But what we do know is that whether you pick momentum, value, low vol, or quality, over a long period of time, we do see strategic alpha or a risk premium, or however you want to call it. There is excess returns that can be generated through a full cycle. So in a more diversified strategy, exactly. And somebody who wants to take a more core approach, that's also why we have like our regional equity ETFs, the All American, All Canadian, All International, where we isolate one region, but we combine the 4 factors. Give you a more consistent experience. In the US, momentum is the only factor outperforming this year. In Canada, it's value and momentum. International, it's value and momentum. But most people would have thought, and even us, considering at the beginning of the year, we really like quality and momentum because quality generally works well in a late cycle type environment. There's a flight to safety, higher profitability businesses. But because of the sentiment change we saw in international markets, notably like industrial started working really well. Financial started really, we need to finance all this, defense spending that we want to add and bring our NATO, percentage contributions up. It impacted sectors that are generally more early cycle.
Gotcha.
And energy, even to a certain extent, is not having a terrible year. So values has worked there. Hasn't worked as well in the US because it's just been entirely driven, it feels like, by this kind of momentum beta rally since April.
So let's talk a little bit more about that because it is obviously the Mag 7 and you could expand that to 10 stocks rather than 7 and so on. But it's also what is sort of following those top stocks, which is contributed to the overall momentum story that you're talking about here. That's where some of the, I don't know if you call them fears, but worries about a late cycle sort of topple exist, it seems.
Yes, that's absolutely, like, I think to me, once again, worrying feels like very kind of scary. That's not the.
You're an investor. You don't worry. You make decisions.
Exactly. Yeah. But it is, I think, once again, cause for concern is probably not the right words, but it's something to keep an eye on because anytime you have, like, so for example, the Mag 7 are now 36 to 40%, like it fluctuates almost like 1% a day depending on their performance. A very large chunk of the S&P 500 index, which is heavily invested via passive ETFs, it's heavily benchmarked against for active managers. So you always have to kind of figure out the contribution of these large names because inherently they're the ones that drive the ship now. And every day that we get a dollar that goes into that index via investment, it's like a snowball effect. They get larger and larger and larger. And as long as they continue to deliver from an earnings standpoint, from a profitability standpoint, now we're seeing heavy reinvestment of not the entirety of their free cash flows, but a lot of their free cash flow going to capex for AI expansion. The issue is the kind of ripple effect, if you will, into names that have not displayed or have not earned the title of being one of these mega cap names that is highly profitable, has really high return on equity, return on invested capital.
Massive free cash flows that they don't need to issue debt or only if they want to.
But there are a lot of names that are issuing debt to fund this. There's a lot of companies that haven't actually generated any profits, but are being compensated like, an NVIDIA, for example, or like a Meta or, some of these other names. So that's the anti-factor part is that you have these
Let's get into that.
High vol names. So it's the opposite of low vol. You have these an unprofitability aspect to it. So the anti-quality, they're expensive, anti-value. And they hadn't really worked up until this theme really started to play out in April. And they're up, 50, 100%, 300%, 500%, 600%. And these aren't like $100 million market cap companies. These are multi-billion dollar businesses going up and very rapidly and kind of attaching themselves to the success of the very large names.
Do we need a new factor for them or they just fit into momentum?
So they get captured by momentum and hence why momentum's working. Right. Obviously, they need to have a certain size. So, for example, in our products, we look at the Russell 1000, so it's a bit larger than the S&P 500. So we will sometimes capture some of these names. The issue is that we also look at risk-adjusted momentum, right? So, like if you just spike, we want more consistent names that have been dry. So we will capture more of the larger ones naturally because of that. That being said, you don't want to change something that's worked for 30 years based off of 4 months performance, right? So these periods generally are short-lived. They happen once we've had drawdowns. Usually it's coming off of a drawdown. This one being very different because it was more trade policy that led it. It wasn't like an earnings recession by these names, which generally will be kind of, we're expecting these companies to be less profitable, or maybe those growth expectations just don't materialize like we expect. So these periods, once again, they happen very often. They happen for 3-6 month periods. It reminds me a lot of the early 2021, right? Where we had that meme stock rally. But it's like the AI trades also transition into, there's the crypto stuff's working. The quantum computing stuff's working. Like there just hasn't been any money made in quantum computing yet. There might be. But there's going to be winners and losers. And hence why, whether it's active management, whether it's a more diligent kind of quantitative approach where we screen for fundamentals, that generally tends to play out over time to, at least avoid a lot of the losers. Not to say that we're always going to pick the best ones. I think that's a wild claim to make. It's more that we're going to avoid maybe some of these mistakes that the market's mispricing.
So and in avoiding them, let's go into the all-in-ones, and we can go more broadly into ETFs. But the discussion of, with a market like this, which is pretty tricky. I mean, there's a lot of discussion when you have your all-in-ones and various portfolios that can be looked at as core to traverse through all kinds of markets. Go through some of the regional discussions. We've mentioned a lot of international, all Canada, but also the US being possibly at just a different point in the cycle. How do you invest for that? How do you suggest people invest for that?
Yeah, no, it's so actually, if we can pull up slide 3, we can kind of overview the way that we look at things from a portfolio construction standpoint with the all-in-one ETFs. And this lineup was initially launched in 2021 with FBAL and FGROW, so our balanced 60-40 and 85-15 product, 85% equity. All of these, I mean, you have the tickers on screen, but all of them are available in funds. Just thought I'd mention that for those listening in. So these are available to everyone. The idea was to create a very core portfolio so that there is no asset allocation bias relative to our peers, and also just a kind of broad classical benchmark. Not really taking any geographical bias, not taking any style bias, right? So hence why we have the diversification effect with the different factors. So we're not
a universe to go in terms of regionally, like you could go wherever, but you're not taking a bias.
Yeah, so basically, I mean, and more from like a portfolio construction basis where, so for example, if we look at our main competitors that had existed for a long time, our objective was to say, we think that this approach with factors, with some active management, we can win on security selection.
Okay.
So we're not going to try to beat them by having more US. We're not going to try to beat them by having less Canada or whatever decision that you want to make from a tactical asset allocation perspective. We wanted to match them and say, we can pick stocks better than you can.
Okay.
Rather than just buy everything with passive.
For sure.
And so in that process, being strategically managed, we're continually trying to stay close to this neutral mix and to let the underlying strategies work. Right, so our value ETFs, they rebalance twice a year, and they change with current market dynamics. Okay. In our U.S. value ETF back in 2022, all of a sudden we had a very large overweight to Meta. Well, it was trading at a lower PE than ExxonMobil at the time, right? So these things are moving underlying. Like it's kind of, I guess I'm gonna mess this metaphor up, but a duck on a pond. Right, so like we want to stay cool on the top, but like there's a lot of stuff kind of paddling underneath the water, right? So that's really kind of the simplicity aspect of it, where they are going to be very correlated to broad market indices, but we want to win over time gradually with better stock selection, which is exactly what we've been able to do since launch. But there are challenging periods, like any product. Nothing is supposed to work all the time, otherwise there's no need for anything else. But the more challenging periods is when we have melt-ups and when we have really high risk-on markets, because from our perspective, these are built for advisors. These are built for Canadian investors that have some risk management in mind, right? Where we don't want to be we don't want downside capture being more than one. That's for sure.
Okay.
And we saw that in March, where these protected significantly better than our main passive peers. But then, yes, we are lagging when you have this kind of euphoric type risk on market a little bit.
But
since
that
April.
said, the flows speak for themselves. They're coming in. There's obviously a number of people who, I don't know if concerned is the right level, but they probably want access to something that is more core, that is steady of the ship to go through this, because it's a fascinating, really interesting, but to some a wild market for sure.
Absolutely, and realistically, like we're trying to outperform on the way up as well.
Of course.
It's just when you have these, we've already touched on it. Obviously, like the kind of anti-factors. So like another way to say it is like junk rallies, and it's not junk per se necessarily, but when you
have unprofitable stuff.
Yeah, unprofitable stuff. You've got a lot of very expensive names are rallying. It's like, yeah, that's not going to score well for us. It's not something that we long term see, and it also leads into a longer term perspective on investing, where it's, yes, this thing might work for 3 months, 6 months, maybe even 12 months, but generally when there is either expectations are missed, and we're starting to see a little bit of that, where it's like if you beat on earnings, you're rewarded decently, not crazily. If you miss, you're getting smacked around pretty bad.
Even if you overall hit expectations or beat, but there's something within there, a particular area of the company.
Could be a comment. It could be.
There's punishment. Yeah.
So ahead. I think it's you're absolutely right. It's that I think the market's like once again like we haven't seen the shift to go defensive, but at any sign of like a crack, it seems like they're willing to get out. Right, so we saw it with Meta not so long ago. It wasn't a bad quarter; it was a bit under expectations, and obviously you saw it like overnight. It was down more than 10%, and that's a massive market cap wipeout, or like size, like the size of value that was destroyed overnight was quite large. So, not to say that that's going to continue happening, but when the market gets more and more lofty expectations, eventually we get ahead of ourselves, and I think. The last point with regards to that in terms of like why we think our approach makes sense as we go forward, not only for the long term, which that's a no-brainer to us, even in the shorter term, we're starting to see the contribution of a lot of those large tech names, contribution of earnings to the total index is gradually decreasing. So that means there's other stuff that's working, but not being compensated for it. And so the multiples you're paying for them might be getting a little stretched.
Tell us about the exposure within the all-in-ones to those 7 names, essentially.
Yeah, so...
I mean, historically, it's always surprising to me that it's not as big as you might think.
Yeah, no, so we own some. I mean, like, these are, once again, I mentioned at the stop, like, they're great businesses. It's just how much do you need to own or do you want to own or which ones are going to be the longer-term winners? I think for the Mag 7, it's hard to make an argument that, like, they're not going to be around for a very long time.
Of course, yeah.
It's more kind of those granular ones impacted by it. But we have right now, I'd say between 18 to 20% in the Mag 7 for like our U.S. equity allocation versus, like I said, double that, if you will, for the index. That doesn't necessarily mean we can't ever be overweight. Right. It truly depends on the screening mechanism of our different factors. Like they score well for quality for the most part, and they score really well for momentum. Sure. Not so much for value, not so much for low vol. There could be a scenario where some of those eventually score well for low vol. Like if they have very stable earnings, which they do, that's a screening criteria that we have. And if they display lower standard deviation than the broader benchmark because tech has become, New World Order, for example. And this is just hypothetical here that we're talking,
staple,
right? It becomes like a staple.
Yeah.
Which actually in 2020, there was actually a few like research papers that came out. It was like, is tech becoming lower vol by the simple fact that we went through a global pandemic and consumer discretionary spending came down. Obviously, a lot of things were closed, but guess what? Like people aren't canceling their Office 365 license.
It becomes a whirlpool example. Like, lots of things may sort of go out the window, but you always have to buy a new washing machine, and you have to buy a new phone. You have to buy, so it becomes a staple.
There's some things that you are going to require, and then obviously now it's because there's other things. But I'm digressing. But really, what I'm trying to get to the point is, we have less. It doesn't mean we'll always have less. Right. We've had more in the past. Okay. But when you have these kind of rallies like this, it's just they fall out of some of the scoring of certain factors.
So some great questions coming in on this. So can you explain the size factor and where it sits within the all-in-one? I'm assuming that means cap size, but I'll take.
Yeah. So size is small caps basically. Yeah. So for us, that's the way we see it. Is that over the long term, we've actually seen. And that's actually very counterintuitive to passive investing, which you're rewarding the largest companies. Sure. Right? Like historically, it's the opposite. It's like generally small caps, albeit you are taking more risk. So maybe from a Sharpe perspective, there isn't that alpha, but it definitely is just from a net returns basis. Okay. Generally, small caps outperform large caps. So that's the size factor. The way that we incorporate it is through active management. And there's a few key reasons for that. First of all, it's a very broad market. So trying to apply either a quantitative screen to it or just saying we're going to buy a small cap index, I think you're missing out, or you're taking on significant risks of the quality of the businesses that you're buying, right? So if you buy, like say, the Russell 2000, there's 30, 40, sometimes even in worse periods, 50% of the stocks that are unprofitable. Right. There's 5 to 10 in the S&P 500. So it's a completely different type of index, which also means that active managers have shown greater propensity to outperform, right? So like they've outperformed more consistently and to a larger, alpha over time. And that just goes back to academia, which recommends, just empirically, that higher active share generally leads to more consistent alpha. Right. So you see that in the fixed income market. Like it's easier to differentiate from benchmark because your benchmark has 5,000 bonds in there. With small caps, kind of the same thing. If your benchmark is 3,500 stocks and you hold 70, obviously your active share is like 99.8%, which active share being the percentage differentials in weights versus your benchmark, right? So I think that's, and we have obviously two outstanding managers that we can use in our global small cap opportunities ETF and fund. So that's the way that we, yes, exactly, that we include in our portfolios.
So the other question is, why is quality and value, why are they not as much of a factor in the US versus Canada and Europe? So kind of coming back to your mentioning at the beginning a bit.
Yeah, so for value in the US, first of all, you're overweighting some of the smaller sectors, right? So you're not like, you're basically taking, and it's kind of the opposite for Canada. When you buy a Canadian value product, you're overweighting the largest sectors. You're overweighting materials generally because they trade at a discount. You're overweighting financials, which generally trade at lower valuations than, say, consumer discretionary.
But they're dividend paying. They're big old clunkers that do well and have their revenue streams.
So in the US, you really need a period where the heavier sectors like comm services, tech, and consumer discretionary, those lag. So and consumer discretionary is actually not doing so well, but comm services and tech are the two best sectors, right? So those are underweight in value, hence why you're lagging. So that's the number one thing I'd say. For quality, it's actually interesting. It's just more of the fact that some of those lower quality, because quality in theory is working. It's just, it's not outperforming as much as we'd like it to, or it's underperforming slightly because we don't incorporate some of that non-profitable space in really growing space, if you will. But it is a place where we thought there would be stronger returns given where we are in the cycle.
Do you think that the sectors, and I mean, you're mentioning anti-factors, which I might get you to just explain. We have sort of a couple of minutes left, but just what you mean by that. Factors are built to sort of isolate something in particular, and we're in what some people call a melt-up, and so it's a different moment for how factors, I guess, work. Is that right?
Yeah, and it's basically, when you build a quantitative strategy or factor-based strategy, smart beta, your objective is to find a risk premium that is rewarded consistently, right? So like value, if you, over 25, 30 years, 20 years, if you pick stocks that are on average cheaper than the average stock and definitely cheaper than the most expensive stuff, like if I consistently buy those cheaper names, do I outperform outperform versus buying the more expensive names? That is held true across multiple different cycles. But there are periods where the more expensive companies outperform the cheaper companies. Right. Generally more short-lived, exactly what we're experiencing right now. And so that's like the anti-factor. So it's basically the stuff that in academia and theory, you would be shorting. Like you would be long the cheap names and short the expensive names. That's the way that it was tested historically. In practice, we kind of just go long the cheaper names. But it would be the same thing for quality. So it's like, we like the very profitable names. Well, sometimes it's the unprofitable stuff that's working more than the profitable stuff. So that's just periods where, once again, they're generally short-lived, couple quarters, sometimes a year, but it doesn't really persist.
This is, all-in-ones are a core product. That's the way you think about those, where you've built them. Just sort of remind everyone diversification comes into something being core, but just kind of as a final thought, what's the value of core at this moment in these markets?
Yeah, it offers diversification. It means that you're also not missing out on certain opportunities. Like we saw it with Canada. It's, you know, if you didn't own, like we have 25% Canadian equities in the all-in-one ETF portfolios, like of the equity sleeve, if you will, a quarter of that is Canadian. Yeah, well, if you own only US, well, you weren't benefiting from that. So like the diversification, I think, argument this year is actually really good, albeit it would have been great to just be concentrated in one theme, which we've talked about at length. You are seeing benefits of other areas working. And on the flip side of that, being core and being diversified will help if we see some volatility. Like even the couple days of volatility we saw, in the last week or so, that's where we really shined, where we outperformed the most. So, performance has been really good. But having a more strenuous, risk process helps us a lot throughout a cycle. And I think diversification is going to be very important as we go forward. Okay, well, thanks for coming to Toronto and making the sun shine here. You got stuck with the snow there, but we're glad that you've arrived here. Etienne Joncas Bouchard, thank you for joining us. Pleasure as always. Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account.
Visit fidelity.ca/how-to-buy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.